will commence next session now. I request you all to kindly be seated.
Okay, 1 second, yeah.
Shanu भैया
We have a presentation on risk management in microfinance, role of insurance. It will be presented by Mr. Rajagopal Raju. He will be a national head, Tata AIG General Insurance. I request Mr. Rajagopal Raju to kindly join us in the dais for the presentation. Please, sir.
Good afternoon. I'll take 5 minutes to give a brief of Tata AG and generally the role insurance could play in risk management. Tata AG is the largest employer in India, private employer in India. We are 150 years old. Financial services is a big play for Tata Group, and that's one of the growth areas we're driving, whether it's general life or lending is a big area of focus for the Tata Group. We are around 15,000 crores large last year. This year we should be around 20,000 crores. Partnerships, whether banker or financial institutions, are a major distribution for us. So we have more than 50 partners, banks, financial institutions, MFIs, offering a range of services across health and other products, covering credit risks and also distributors for insurance. We are one of the largest partnership tie-ups, and we do varied businesses across various partners. In terms of one of the key factors for us or for the industry is on the product design. Traditionally, we used to file a product and try to see where all it fits into the financial institutions book. Today, more and more companies are coming up with products specific to the business model and the risk of a financial institution's book. So that's been our thinking. So all companies, including us, have filed more products, have come up with innovative products to deal with specifics of a partner rather than trying to fit the traditional products we have. Also distribution, the way you collect the premium, the way you dispense the policy, claim, the whole service architecture is aligned with the specific business of the MFI or the financial institutions. The traditional collection of papers for claims or business, that doesn't work anymore. So we align ourselves to the partner's business model and the particular asset we're dealing with to design our products and design our services. In terms of broadly two areas, again I'm sure a lot of you would have seen this. One is on protection of the underlying loan itself. Traditional life was the dominant player, where death was a major cause for delinquencies. But hospitalization actually is one of the major reasons for not paying or loan going NPA. So there are more and more products around daily cash or CI and other insurance products which are trying to deal with non-death events which lead to NPAs. Secondly, also as a revenue source, insurance, especially microfinance products, are a great way to increase revenue for the financial institutions. Again, you have to adjust your product for the channel you want to sell and the customer profile of the financial institution. So the need to balance the products you're selling with the channel is very important. It's not just risk protection. A lot of times, small event, let's say hospitalization happens. A 2-3 day hospitalization might seem small, but probably the person ends up paying whole months or a quarter's money into that hospitalization. So the person cannot pay for loans anymore. Traditionally, we had the daily cash kind of concept where you pay a fixed amount. Now, more and more insurance are filing EMI linked products. So we pay a particular number of EMIs, and not a fixed daily cash. That's what I mean by adjusting your product to meet the needs of the partner. There around property, loan protection, health and accident, asset and livestock, we have products. Across the insurance industry, we have multiple products designed for every size and every kind of loan. Especially with Tata AG, the whole, we have an end-to-end digital platform for integration with partners, so we can mimic whatever the partner wants us to do. In terms of distribution, collection, claims, any aspect of servicing, we are digitally enabled to tie up with the partners. So again, finally, by Tata AG, we have multiple products dealing with specific requirements of every partner, whether it's on loan protection or to increase the revenue source for a partner around health, motor, any microfinance product also. We have products dedicated with the servicing architecture required to deal with the partner. We have more than 2,000 employees just working on banks and partners, not agency, but just partnership. We have more than 2,000 member team, and teams are dedicated for each partner. And we think that's a key to success, because each institution is different in the delivery model, is unique in terms of the book they manage, it's unique in the way the processes run. So we as insurers, we need to adapt ourselves to the partners' needs. This is what I wanted to say. 5 minutes, I think, 8 the time. Thank you.
Thank you, sir, for this short and insightful presentation. Now we go on to the breakaway session 4, strategic pathways for MFIs, navigating change and embracing opportunities. May I request the moderator and speaker of the session to kindly join us in dais. The session will be moderated by Mr. Jai Krishna Ji, partner PwC. The speakers are Mr. Rahul Gupta, Director and CEO Avanti Finance, Mr. G. Kiran Kumar, Director and CEO Samman Financial Services, Ms. Nalini Venkat, Chief Business Officer, Digit Insurance, Mr. Abhijit Ture, Co-founder and MD, United Capital, Mr. Gaurav Arora, Business Head, Branch University. So this session will outline the long-term roadmap for microfinance institutions in India, focusing on strategic growth and sustainability. So I would hand over the session to the moderator. Sir, you try to close the session by 1 minute.
Good morning, all. Welcome to this panel. The topic we have is strategic pathways for microfinance institutions, navigating change and embracing opportunities. I have a very esteemed panel and a good balance of panel members. Some of them successful MFIs and different models of how MFI business is being conducted. And we have an investment banker, we have an insurance key person here. So I'm hoping we would be able to cover all aspects of building a successful strategy in this session. And looking forward to this session now. Let me start with welcoming all my panel members, and maybe we'll start with a brief introduction from Rahul, and then we'll introduce all of us and then start.
Good afternoon, everyone. Pleasure to be here. Hope we can share some interesting insights with you. My name is Rahul Gupta. I lead Avanti Finance. We're NBFC, NBFC, MFI, a new age company really doing small ticket lending for largely income generating loans for the microfinance segment. Thank you.
Hi. Can you hear me? Hi everyone. My name is Kiran Kumar. I lead a very new NBFC MFI called Swaman. I think we are the latest entrant into this segment. We are present across 12 states. We launched just prior to COVID, and we have built up a book of around 1,000 crore today. So pleasure to be on this panel and looking forward to the discussion. Thanks a lot.
Hi, I'm Nalini Venkat. I'm from Digit Insurance.
Good morning, everyone. I'm Abhijit. Been in the industry for 2.5 decades. Still a learner because of a lot of interesting things that's happening around. I'm a co-founder of a group called Unitas Capital, which has 3 different entities. One is the investment bank called Unitas Capital itself, which has more than 32,000 crores of capital for 200 plus companies. We have an NBFC called UC Credit, where we have supported early stage businesses and NBFCs about 2,900 crores in the last 5 years. And we have a small private equity fund which is just started. It's called UC Power, where we do $2 to $4 million investments in early stage businesses, mostly NBFCs and climate companies. Thank you to be here, and thanks Sadhan for inviting us.
Hi, good afternoon everyone. I'm Gaurav Arora from TransUnion Civil, which is the largest credit bureau in the country. I represent the business. I head the businesses for TransUnion Civil. And we work with all the financial institutions, banks, NBFCs, fintechs, and MFIs for everything related to risk analytics and from a data management perspective. And thank you to Sadhan for calling us in here, and happy to share my insights with all of you. Thank you.
Thank you. So as you could see, the panel is diverse and also encompassing all aspects of building a successful strategy. Being a consultant, we work on frameworks and we ensure that through frameworks we cover all elements that are to be addressed when you do a project, especially when you try to build strategy, right? Today, as we all are hearing and as we are exposed to in our ecosystem, it's not just the change that usually happens, and there is a lot of variables that are beyond the normal changes, which is actually causing a little bit of, if I may say for better English, a little bit of pressure on how microfinance institutions are forced to reinvent themselves, are forced to kind of relook at the business models and see how do we eliminate the non-value adding part of what we currently do, and how do we rebuild and succeed in a manner that gets the right returns as well as meet the primary objective of financial inclusion. So on that note, like I said, a framework, what we call as Fit for Growth, it encompasses all the elements of strategy. We'll start with the 4 elements that all of us know are who is our customer. And it can't be a moving goalpost, right? But at least for MFIs, the good thing is you acquire a customer, you add capabilities, capacities, and then transform them into a better customer for larger organizations, and as well as continue to work with them. So customer as one important part of building a strategy. Then the product, and our product is lending. We heard insurance, which is also an important product from a distribution standpoint. And then the pricing, and lastly the channel. So we'll start with how these 4 elements of strategy are playing out. We'll hear perspectives from our panel members. Let me start with Rahul. Rahul, you may want to take it your way, but you can give an overview of how this has evolved in your case, and what are some learnings that our audience can take away from here when they start looking at next 3 years of designing their business.
So thanks, Jay. Avanti is a relatively new age organization. We were formed about 7 years back, and we started active operations actually just the year prior to COVID. So we are a COVID baby, and there's lots of learnings that came through that survival which happened in our infancy. Our goal was very clear that we wanted to build a population scale platform and usher in the next generation of financial inclusion. We wanted to create a platform. We wanted to build a business which would leverage network effects by having partnership models that gave us reach and access to our customers in a cost-efficient way. So there are a couple of things that we did differently from what's been happening over the years. One, we looked at kind of where India is headed in its digitization journey and how customers will evolve. So we're looking to build a platform for the future and not really being overly focused on what had been built so far. Of course, taking the deep learnings that have come out of the evolution of this sector over the last 15 years or so. So, couple of on channel firstly. The things that I'm sharing are perhaps some things may work for some people, some may not. But I will share in transparency what we tried and the challenges around them and what's working. Firstly, we were very clear that the customer segment we wanted to serve was the low-income households, similar to microfinance segment. And today, out of the 1,600 crore book or so that we built, about a third of our customers are new to formal loan. And then there are another 25% customers who are thin file customers who typically would be rated high risk by the bureau. But we look at them and we try to figure out the circumstances which made them go delinquent in the past, and we still try to lend to them if we feel that there is confidence to sort of look at the current situation and take an exposure on it. So first thing was distribution. We were very clear we wanted to build an asset-light model. So what we did was, instead of creating our own real estate infrastructure, we partnered with other MFIs, AgTech, new age AgTech players, FPO organizations, not-for-profit organizations as well, who were serving the same customers as well. And what that's allowed us to do is that it's allowed us to build a presence across 27 states today. We have served customers in over 23,000 villages in approximately 500 districts, all in a matter of the last 5 to 6 years, and we have only 130 people in our entire company. So our premise was that the reach that existing players which have strong affinity with the customers gives us will take a long time to build. So we would rather partner with them and build a model. Now, there are many, it helps in scalability, it helps in getting local market knowledge to design fit for purpose products, and it also helps to get on ground risk input from our partners to underwrite data to our customers. That's kind of one thing on the model. The other thing that I wanted to talk about was on the capital side. With the lofty ambitions that we had, we were very clear it's never going to work if it's a proprietary balance sheet model. So we started off by lending through our own equity because we had to prove that this model has gravitas and it will work. And once we had lent about 800-900 crores or so of through our balance sheet, we also started with co-lending because large financial institutions have partnered with us, because what we give them is additional reach to what they have built, and co-lending is a very good way for us to be able to expand our business and not be in the constant equity raising treadmill. So on one side, try to keep it asset light. On the other side, we've tried to get good financial institutions and bridge the gap between quality capital and the people who need it the most.
Excellent. So a classic example of how you are starting off in terms of building a successful network and therefore increasing the customer base. That's what we heard from Rahul. Kiran, on the other hand, most of your book is on your own. Could you just explain how the journey has been and what you plan to do?
Yeah, so it's a pleasure to be here, everyone. So I think the topic for today is embracing change and looking at emerging opportunities. So I think as all of us know, and over the last day, a lot of us have been talking about the challenges that have come from the regulatory changes and how the sector is seeing a lot of risk building up. But I think I would like to take you back to 2010 when the sector was hardly 20,000 crore. And from there we have reached 4 lakh crore. This 23x growth is just unprecedented, right? So it just talks about the level of financial inclusion which has happened in the country. And if you look at the journey itself, a lot of this growth has only come in the last 5 to 7 years, I would say. Because just pre-COVID, we were talking about maybe hardly 2.5 lakh crore of portfolio, and now we have touched 4 lakh crore. So I think the fundamental nature of the business is that it caters to the bottom of the pyramid in a manner, and the regulatory definition of under 3 lakh means that nearly 70% of India's household qualify for this, right? So we, at a fundamental level, we are catering to the masses of the country. So that market is not going anywhere. So I think in embracing change and looking at emerging opportunities, I think one constant we have is that our market will always be there. I don't think the market is going anywhere. We are, the largest populous country, and that market will exist. Now coming to the change, what has changed is that 10 years back, when a field officer used to go to a village, he used to get a center, which is the JLG concept, of 30 customers with an 80% approval rate, right? There were hardly any rejections. So now I think we moved to a stage where that has inverted. I think that's where a lot of players are struggling to, operate in the new setup of things, because now the approval rate is 20%, rejection rate is 80%. So I think that is one big challenge that we see, because earlier, this used to happen in maybe only the southern market, northern markets were the open territory. A lot of SFBs always went after the next geography which was not included. So, for example, Utkarsh was started in UP, maybe there is another bank which started, NBFC which started in another territory where southern players were not prevalent, and they went after territories. But now I think today that territory issue is gone. I think every territory is very well penetrated. I think that problem doesn't exist anymore. So what we have to now focus on as a sector, and that's the indirect clues that regulator is also giving us, is that as NBFCs, we have the responsibility to do this thoughtfully and to do this in a manner which is very risk focused. I think that is one big change which is coming into the setup. The olden days of just giving loan to anybody who is able to access it are no more. It's no more the case. I think the biggest cost, we keep talking about OPEX, but I think the biggest cost, which is the hidden cost, is the credit cost. So the regulator with their risk-based pricing mechanism is actually pushing us that you first understand where your risk is actually coming from. A lot of us haven't even thought about it, because earlier anybody who wants a loan gets a loan, right? That was the mechanism. But now what the regulator wants us indirectly to do is that think about where the risk is coming from and do not penalize the good customers because of this. Because at the end of the day, the credit cost gets built into the overall cost that you are charging every customer. So they are asking us indirectly to think about how you are underwriting, be more robust, and that kind of defines the end price for every customer. So if you don't do a good job on underwriting, then the actual rate for the end borrower keeps spiking. There is no end to it, right? There is no end to the price that you want to charge to cover up for the credit cost, because that's not going to go anywhere. So I think that's one big change which is happening in the sector. And we, as a sector, we have to gear up for that. I think from a sustainability standpoint as well, because at the end of the day, we are catering to the bottom of the pyramid customers, and our focus has always been on providing a very affordable solution to these bottom of the pyramid customers. So we shouldn't, divert away from that mission, maybe hiding behind escalated credit costs. I think that's one big theme that is playing out. In terms of emerging opportunities, I think the customer maturity level pan-India is not a one-size-fits-all. And this is one theme which is again playing out, right? Even though the regulator says that the income cutoff is 3 lakh, it doesn't mean the income cutoff is 3 lakh in Karnataka and Tamil Nadu, and the same income cutoff is the same thing in maybe rural Jhansi or rural Madhya Pradesh. I think that's a regulatory guideline. It's up to us, each one of us, to define what is the right metric for that particular state, considering the situation of that state. I think that is one movement which has to happen. Right now, what happens in Karnataka, generally people just do the same thing in the northern states, which is causing a lot of the problem today. So I think that is the other theme which we have to think about. And the third point I would like to summarize on the opportunity side is from a customer maturity standpoint. I think the customers are much more mature than our staff in terms of understanding the lending products. They understand our loans, they understand which players are good, which players are bad. I think now we have to cater to their specific requirements on what they actually need rather than giving a plain vanilla unsecured product. Which might or might not cater to their requirement, right? So I think that one big theme change, we all have to think about how to accomplish that. Because if it's a very specific intervention, you know, that kind of reflects in the end pricing for the customer as well. So you might not need to do a 24, 25, 26% blanket unsecured product. If they need a house, maybe the product can be lower priced. If it's a business loan, maybe it's a different kind of setup product where, you know, they get a better terms. So I think that is where we have to innovate further. I think that is the opportunity that I think about.
Excellent. I think Kiran made a very important point that need to go in everyone's mind when you are trying to draw the strategic plan for you, which is knowing your customer really well, right? And also looking at what is the problem that I'm trying to solve for the customer, and how do you underwrite, how much do you really want to stick within the plain vanilla broader construct of the products that you're used to. If you are competing with a certain set of players in the sector, do you want to do the same? And then, like one of the interesting points you mentioned about the risk that is actually for the customer. That's more important here, because while it is a risk for us in terms of the cost, but the whole purpose of our doing all this was to alleviate poverty and bring livelihoods and give access to formal credit to a segment of customers. But if you actually push them into a risky situation where they are over indebted and they're not getting any further credit, then the whole purpose is defeated. So therefore, that's very important to keep as a lens when you plan for your strategy. Look for white spaces, look for areas where you need unique underwriting methods so that the products can be also tweaked to that extent. Let me come to Nalini.
Yeah, I would like to add in a point here, if I may, please. Thank you. So, the way Kiran has mentioned, see, many years back, distribution was supposed to be a strength. Then the democratization of distribution happened. Today, the distribution is far easier to achieve. After a few years, digital was a strength. Now, digital onboarding platforms have also democratized. From a legal and regulatory perspective, RBI is ensuring that at least that democratization is also there, so there are no arbitration anywhere is possible. So, very rightly put by Kiran as well, that how do we now create a differentiator for the industry? And primarily from, say, a data and analytics play, how do you know your customer better? How do you further segment the customer better? And that's the reason why a 20% kind of an approval rate can be changed, because today from a data perspective, whether it's a golden source, whether it's different sources available in the market, a lot of people have similar access to data. What you do from a scorecarding perspective, from an analytics perspective, how do you segment these customers becomes very important as you move forward. So just want to make this point.
Brilliant. Thanks for that. Nalini, you may go ahead from a perspective of distribution as well as adding most important cover.
Yes, thanks, Jay. Now, I'll build upon what Kiran spoke and go back to data perspective. Before we get there, I think microfinance as an industry has done a phenomenal job in terms of financial institutions. I think today the industry has achieved a level of maturity and scale where we need innovation in terms of product, innovation in terms of pricing strategy, and also augment your network. What you have built is last mile, connectivity, financial inclusion, which I think banks have not been able to do even after operating for multiple decades now. So microfinance need to reposition themselves as, today government is using banks to incentivize the last mile distribution of their social welfare schemes. One of the example is PMJJY, which is the Pradhan Mantri Jeevan Bima Yojana, where they are depending on banks to do this, whereas microfinance companies are best suited to do that. The second thing is that there are many schemes like Ayushman Bharat. Can we have a supplementary product to Ayushman Bharat? We see that a lot of, we are entering into an era where there's a lot of freebies which has been rolled out for every elections we are seeing today. And there are a lot of women-specific schemes which are running, maybe it's in Karnataka or we are seeing that in Madhya Pradesh, Maharashtra. So this is the segment where microfinance companies operate. Can we look at a small saving scheme for these women because they are getting these benefit from the government? They can use this to plan their future for education of their children, for marriage, or whatever is the financial goal they want to achieve. So I think from a product innovation perspective, these are the few things I am envisaging in future. And secondly, coming to the pricing perspective, we know that the regulator is also very sensitive about what kind of interest rate we are charging. There are two ways to look at it. As Kiran mentioned that, we have enough data and there is data also from, whether it is, fraud is a behavioral issue. So, and a person who does fraud in not paying the repayment of a loan will also defraud an insurance company and defraud an e-commerce company. So, what we have seen as Digit, which has helped us, is that we share a lot of information with our partners. And when we were working with e-commerce companies, there are certain PIN codes they don't want to service because it is prone to fraud. When we checked with our insurance data, the same PIN codes we saw were having behavioral fraud issues. So I think that sharing of data between various industries will help us to understand how do we weed out fraud, because there is no cost to fraud and it is actually draining your profitability. Third thing is segmentation in pricing. So insurance, as similarly to microfinance, we were all doing average pricing, and then we realized that good customers should get good price and bad customers should get a bad price. So when you start giving good customer a good price, you will attract more good customers to your book, and that's when your profitability will increase. And my last point is augmenting your interest income with distribution of various other products, which most of you are already doing. But I think going forward, because you already have a network and you have people at the ground level, leveraging this to get a non-operating income or augmenting it with cross-sell would be a great opportunity to manage costs and increase profitability.
Excellent. I think the important point that is emerging from all what we are hearing is putting customer at the center and working around the available G2C services, distribution models, sweating more what you have built in terms of assets. Those are some themes that are emerging. Let me go to Abhijit. Abhijit, from an investor standpoint, you represent an important constituency in the ecosystem. How do you see the changes that are currently happening, and some of them are perceived as, not at least in the short term, from a challenge standpoint? How do you see those changes, and what would you expect from an investor standpoint when the microfinance institution build their strategy? How do you kind of build for all these challenges that are out there?
Thank you, Jay. I think our Indian panelist has covered quite a lot, but let me start with a statement. The recent event, what has happened, that two of the MFIs have been asked to stop lending for some period. Now let me go back to history to say, we started microfinance lending in 1994. Today we are at, after 30 years, only two institutions in 30-year history has been asked to stop for a period of time. And if you look at during this period, a lot of banks have been asked to stop products. A lot of NBFC has been asked to stop lending. So guys, don't we think we should give a pat to our back, working with the most vulnerable segment, building a new industry, and after 30 years, only two. So we have done a tremendous job as an industry. First, let's accept that and give a pat on our back, right? Now, it's important to understand. See, Number two, India is the one which started microfinance almost at the last country. Bangladesh started it way back in the 70s, followed by Latin America, which grew crazy, whether it's a village-based lending or individual lending to a group lending, all sort of things people have done, right? And today, actually exactly after 10 years of our start, or approximately 12 years of start, India became the most operationally efficient microfinance market in the world. I repeat, it's the world. So why are not acknowledging that we have done this so well over the years and being the best? RBI at some point regulated the interest rate and we are still profitable. We moved from obviously a group based from a weekly to a fortnightly to a monthly model, but still we maintained profitability and grew it at this breathtaking pace, which my friends have already talked about, right? Number three, see the focus. It's such an important sector that we fall under private sector. That also speaks volumes about government focus and the need to reach there. After almost 12 years, we still are under private sector government. And now the question is that what we need to do after this growth to move to the next level, right? And next level is about the smaller entities. See, today bigger entities have capital, resources, capabilities, and I think the structure to take things forward. So let's for a moment talk about the smaller ones. And we as the industry, what we need to do, right? What is the major challenge for MFI today? As Kiran running an entity or Avanti, from Rahul running Avanti, you could grow at a certain pace because you have access to capital. So my major challenge today is access of capital, right? And if access of capital has to be addressed, it has to be looked in multi-dimensional format, not a single format. First of all, Jay talked about client. What are you thinking about the client? We are all talking about over lending. We are talking about average ticket size growing. Now think of it, the growth. Can I talk about 4,30,000 crores? Any idea like which sector? Which type of entities portfolio has grown? There are 4 categories, and my friend is here who did all the analysis, presented amazing finding out of CIBIL in Bangalore conference very recently, like last week. It says the segment which has supported MFI or microfinance clients and grew the fastest is actually NBFCs are not NBFC MFI. Their growth has been highest. Now why? What happened there? First of all, obviously the RBI regulation to say that they can do up to a certain percentage, microfinance is definitely helped. But what has helped is the average ticket size. If you look at it, their average ticket size is the highest compared to anybody else. So look at the data, fantastic presentation they did. Look at that data. So why they could do that and others we cannot do that, right? Microfinance remained, the NBFC actually remained stagnant. Banks funding has actually gone down, right? So NBFCs, others have picked it up, correct? So again, going back to the point is capital. I'll come to how we address that. Number 2, again the data from his presentation. We are talking of urban. We are talking of the clients in the urban area or semi-urban and all are thronging there. One client being chased by 4, 5, 6. I'm not trying to say it is wrong because we as a business entity has to do that, right? But think of it, the data what was presented recently by CIBIL says that in a small ticket or rather I would say consumer lending, new to trade customer from 2019 just before COVID to today has reduced from 17% to 9% or probably about 8. This is a decline in new to trade customers. Does it exactly follow microfinance? Because this data what we presented was for 2019 to June 2024. I don't have the same data for microfinance, but what I got from the presentation was from March 2024, 23 to June 2024, the microfinance new to trade customer reduced by 2%. There's a correlation. Can you see the correlation? New to trade customer reducing. So what does that mean? My portfolio has grown over the years, right? But new to customer is reducing. So I'm focused on the same set of customers putting in more money, correct? So over-indebtedness comes from there. So how do you do an NTC? How to go to NTC customers? the simple thing is you have to go deeper. Again, their presentation says the rural coverage is so low today. And the opportunity of rural growth is much higher. It has gone by 36%, and slightly more in the last few years. So look at that. That growth is happening, but you have to go deeper, right? So can we focus on our new to credit customers? And as you all know, again, their presentation justifies that the lifetime value for new to credit customer is much higher because your reverse ticket size goes up. You can do multiple products in there. So your income per new to credit customer is much higher than the existing customer, right? So focus on client and see what we can do on the client side so that we are not over-indebting them and moving to a geography and try to see that we go deeper. Now coming to a client per se, I mean, why a client will leave from you? Is there a way to say that we are there for you for whatever you need? And I'll come from both the income side and also the client at the center of everything, if you put it that way. Today, I mean, India as such suffers a lot from a social security perspective. And you know the focus of the government. They are creating department separate trust to say that how can we ensure pension is something which we can go deeper, right? We have to ensure social security. So what else can we build with the customer so that they cannot move out from us? I'm not saying you have to push him with a loan. You have to think of pushing him on the side that how can we protect them from a social security perspective so that they are with us for longer. They don't leave us. Just for the sake of 2%, they don't leave us. See, the industry where the customer moves very fast is vehicle finance, two-wheeler finance. Very fast. It's only a price difference of here and there they will move. But that doesn't happen in microfinance so fast. Microfinance is the lowest actually. Again, the data shows that. So can we see what can we do around that so that the customer remains with me for long? I mean, and also from a contribution perspective, one, it increases income, no denying the fact. Two, from same branch you can operate, so the efficiency also increases. Three, I recently, just today morning I spoke to another entity, they said my profit, 12% or slightly more than 12% of the profit is contributed by this other product. Profit. I'm not talking of income, it is the profit that is being contributed. So which is like my ROS goes up, right? So that's where I think we'll have to think from a customer perspective, right? And how to increase our income. Second, the most critical part, we can't grow without capital. So what we do, I'm coming from a perspective of what as an SRO we should look at, as an industry we look at, as practitioners we should look at. Now, you know, you hold as an MFI, we hold the largest distribution network. No denying the fact. You think why insurance company Digit is here? I mean, all said and done, they cannot reach them. I mean, it's fact. I'm not trying to demean anybody here. It's fact that you need a distribution network. And who gives that network? The MFIs. Who is the richest in rural areas? The MFIs. So if we have that distribution network, how do we do a strategic relationship? And I emphasize on this. What I mean by strategic relationship. Now, I'm not talking of Digit alone. I'm talking of everybody who is trying to sell a product on the ground. Like whether it is a Sun King, whether X, Y, Z. Everybody is trying to sell a product because this is the new Bharat customer. We have to make money. So if you have to do that, tell them, I mean, try to negotiate. Can we, I'm not talking of Digit per se, anybody for that matter. Can we try to say strategic partnership? Put a 5% equity here. Put a 5% equity in the company. You don't need to do a lot of money. So that I get a validation that, you know, there is an insurance which is with me. I get a valuation that there is a distributor with me. And if they have a concern on the exit immediately, don't worry, do an OCPS. Option is converted to preference shares. The capital adequacy goes up. So what is the challenge to this capital? This could be one option. I'm, of course, happy to make a discussion after this also, but there are multiple ways to structure this, right? Think of it. Yesterday somebody was telling me, how do I sell more electric vehicles on the ground? I said, you have all the MFIs there to partner. Have you thought about this? I said, yes, I know about them. I want to do it, but why they will do it with me? I said, boss, make a strategic investment. They will do it, right?
Yeah,
so
thanks.
this is the value. Sorry, I'm coming in I know it's a topic I would love to talk more. Coming from a capitalist angle.
I'll give you the details.
Yeah, so I'll finish in a minute probably. Sorry. So I think as a last thing, as an SRO or as an industry, we should think of three things. Correct? How do we ensure that our capital comes much more easily? Right? You know that there is a microfinance equity fund. Over the years, it has been there. Now we very well know what is the utilization. There are some challenges. My alumni CP runs it, so I know there are some challenges. But what can we do as an industry to address that challenge and see that the 400 crores entirely is put into the field? It helps. SIDBI validating an entity helps from a private equity perspective. Two, can we set up regional funds? I mean, why only SIDBI? The other day, can we think of that with more funds? Three, why can't we, at least Bangladesh got a negative things to learn, but they only showed us the way, right? For microfinance. Why don't we think of a PKC model? So much money comes in from outside to fund. We can do that as well, right? So I think, once I get a mic, I go on and on, so apologies for that. So, thing is, there are a lot of things to be done as an industry, because we in 30 years have achieved a lot. It's a question of few small steps which can lead to a larger outcome. So let's all work for that.
Thanks. Abhijit, in fact, specifically requested that he should speak before Gaurav, so that he could use all the data Gaurav has. Any which ways, I think, thanks for that heads up, Abhijit. I didn't expect this much. Gaurav, anything left from the data that you've got that please share with the audience?
Yes, tons of that, yeah. I can spend another 5 minutes on that.
Look, we are already in this.
We'll move to another restaurant.
Then go ahead.
Yeah, should I?
Yeah.
All right. So, see the way, and Abhijit also mentioned, see what we need to see is what has clicked for the country in the last 10 to 15 years. Retail lending has really clicked in the country for the last 10 to 15 years. It has worked very well. Look at the delinquencies, look at the size of the portfolio, look at the way they went as well. Today there are about 25 crore live customers having a retail loan. There are about 60 crore customers who have ever taken a loan in this country or ever applied for a loan. When we look at microfinance, this number stands at 8 crore. While of course it's a great number, last few years has seen a great growth as well. But look at from an opportunity perspective, there is still a lot more opportunity to go into this space, because this 8 crore represents from a denominator perspective a much larger India, a much larger Bharat as compared to, for example, a retail lending. Second, very rightly put by Abhijit about the new to credit customers. Now, the data says that a customer who has been given 3 or more than 3 loans, their delinquency rates are more than double as compared to the other set of customers. Which means we as an industry was scared of giving a loan to a new to credit customers. We ended up over leveraging similar same customer by multiple lenders, by multiple top-ups, and eventually they defaulted. Rather, a person who has an outstanding of more than 60,000 rupees, their default rate are more than 1.5 times of customer who has a loan outstanding of less than 20,000 rupees. So while we would have underwritten a higher amount to this customer, their delinquency rates are also higher because of over leveraging. About 1.5 years back, we had flagged this concern from a retail lending perspective, and at the end of the day, consumer is a consumer. Same stuff happened about a few months later on the MFI side as well, which all of us as an industry are seeing. And that's the reason why one more area to look at it is, one is of course new to credit, second is the overlap on the consumer side. Lot of customers are now moving to, and our data says that 20% of MFI customers also take a retail loan product. How many of us check the retail book or a retail footprint of this customer before giving an MFI loan as well? So, and this number has doubled in the last 2 to 3 years. As we move forward, this 20% will become 25, 30, 35 because people will graduate. From an MFI loan, they would want to get into different kinds of loans which are available in the market once they have a good repayment history. So my only request to the industry here is that start looking this data, don't be too afraid of NTC, start looking at this data from a lens of both MFI as well as the consumer footprint, and then try to lend to this customer for better results. So these are a few points about that.
No, but I think, look, we are, the allotted time we have with 6 minutes. But I would want to make the best use of the 6 minutes. I know our eminent panelists are very clear what used to say, and this is a topic, like I said, very applicable to us. Can I ask if any of you want to raise any specific question to any of the panelists? Please stand up and raise your hands. We will take that. Otherwise, we can consume 6 minutes, 60 minutes, whatever. You have a question? Can someone give him a mic?
And if you have a question for Abhijit, then we'll have a separate keynote speaker. Slot for that. Remember that.
Slightly controversial potentially. microfinance by design, we tend to women. That's been the history. That is the present as well. We tend to lend only to women. And
So
with the
I can't hear you, so you can use this mic.
I think your voice is good now.
Hello? Better now?
Yeah, better.
So, with the advent of digital tech as well, a lot of the concepts of the group lending and why women tend to be more secure, and with the advent of good data supporting credit underwriting, is it time that now can we look beyond that? So, while yes, MFIs are supposed to be empowering women, is it time now, maybe not new to credit, but at least new to MFI kind of a segment? Is that the potential? Because the RBI never stops us from lending into it.
Is this, you want any of these specific panelists to answer this?
Maybe the industry folks could bring in a view.
Kiran, maybe. Kiran.
Yeah. So I think you're absolutely right on the unsecured lending side. Is that if the financial literacy levels of the customer on the credit bureau and the implications of credit bureau are internalized, like in a developed market, then you're absolutely on point, right? That unsecured lending through a digital means completely, and there are enough fintech players who are operating in that space can fill that gap. But here, I think the only caveat is the end customer has to be financially literate. They should be aware of what an APR is, and they are in a position to reject your offer if the APR is deemed too high. I think that is the fine gap which is still not filled when you go on the field, because a lot of our customers first do not have access to that kind of a capital, and the second thing is a lot of these customers, we actually teach them first time how to sign, and that's the beauty of our product, right? We are actually bringing them into the formal financial services landscape, and then we are teaching them the fundamentals of what is debt. So this is the audience we are talking about. And if you look at the rates, and maybe Abhijit can add to that, MFI lenders, for all the press that we get, we are actually much lower than any fintech lender in the country. Much lower, right? If you look at some of the IRRs that the fintechs charge, we are much lower. Even considering the high feet on the street cost, the high OPEX model, the way we kind of approach the customers, everything is phygital. That's why the cost is kind of built in. But then we are actually charging a much lower rate on very, very transparent terms. A lot of the digital guys won't believe me, but we don't charge any overdue fees. A lot of us don't even charge overdue penalty, forget about penalty, we don't even charge overdue interest also. Even if they are delayed, we stick to the original schedule. Look, you pay what you feel like, right? We don't even push. So I think that's where we are as a MFI sector. And I think the second element to this is the entire operationalization of this model hinges on the fact that you can cater to a set of customers in a single place in one shot. So giving smaller ticket size loans, you can cater to maybe 10 customers together. So even though the risk element of the joint liability group doesn't work that well anymore, but the operational effectiveness still works, because I'm able to cater to 10 customers in a single setting. Think about it like a Swiggy guy delivering to 10 customers in a single apartment, right? It's much more operationally effective, and I can give much better service, and and maybe 40,000, 30,000 ticket sizes are immaterial. So I think that element is still there in the market.
Kiran, I think, we really are running short of time, but I want to make the best use of everybody's time here too. So what I'm going to do is I'm going to give 2 minutes to each of you, just 2 minutes, okay? In which you're going to say how, if all of us around here were to relook at our strategy, how is it to be done, given with all the challenges, opportunities, everything that has changed, digital infrastructure, all that. Just 2 minutes. This is your, quick 2 minutes, rapid fire kind of a thing, please.
So I'm going to, use my time to be a little provocative here. Let's kind of address the elephant in the room which everybody is grappling with today. With increased regulations, cost of funds not being what we want to be, heightened risk, how do we get to profitability with the spreads that we have and address the holy trinity of cost of funds, cost of credit, and cost of operations? So I think on the risk side, clearly the social collateral model of JLG, I don't think it's going to go away quickly, but my personal belief is that the beginning of the end has started. And one has to get into a philosophy of being able to have the risk management capacity and capability to underwrite the underlying customer and the asset. You can no longer just base your risk management on a philosophy of saying, I have on-ground relationship with the customer and I have effective collections, and that's really what risk management is about. You have to underwrite the end customer. And that was there for a time when customers didn't have identity, you didn't have elements of the India stack, so on and so forth, but all of that has come now. It's an advancement from just physically. So, it's an in-between, it's a transition period. And it's fine. Today, if you look at our customers, only about 45 or 50% of them have a smartphone in a household. 91% of our customers are women, and they may not, the percentage might even be low. But what happens is that the loan origination system that is on which they're onboarded in an assisted mode takes out the friction. Including household assessment, in about half an hour's time, the customer is onboarded, and in about 24 hours they get a decision, and in 24 to 48 hours they get money. The next step is how can you build how do you build technology that allows you to build products that are fit for purpose for the customer and are hyperlocal in nature. You can't have everybody being forced to take a monthly repayment product or a weekly repayment. You have to look at mirroring the revenue streams based on different livelihoods and have a technology stack that can then say, here is a customer segment that needs to pay daily. Does my technology allow me to do a daily repayment product and a monthly repayment product and a weekly repayment product and a bullet repayment product? We need all of that. And if we do that, then we can layer it also to do risk-based pricing based on different categories of customers. So, technology, risk management, operating models all have to change, and it's possible. We've seen some green shoots of that, some we've tried, we're seeing it around us, but just sticking to what's worked for the last 20 years is like driving, looking at the rearview mirror.
Yeah, so I think we summarized a lot of the discussion points already. So I think going forward, from a strategy standpoint, as an entity, we are focused on how do we cater to the household. I think that is the shift that we have to do. Till now, we were focused on how do we get people into the financial services, formal financial services, away from the informal money lenders, right? So that was the motto of the entire financial inclusion drive that MFIs were doing. But now I think we are moving to the next stage where we have to look at every household and cater to what are the needs of that household. I think that is the transformative journey which we are on, and that can include, as diverse a product as maybe it's an insurance, maybe it's a home loan, maybe it's a vehicle loan, because that's the life cycle of the customer. And who better to cater to that requirement than us, who is meeting these customers on a day-to-day basis, serving different products even today. So I think that is the journey we have to rethink. And with regulatory support, obviously right now the way regulations are structured is that even if I have to do affordable housing, I have to take an HFC license. If I have to do MSME, then I have to do NBFC license. And MFI is a pure plain vanilla unsecured product. So then I have to segment 3 different companies. But at the end of it, the household is same. It's the same household. So I think that that is the way forward I see in this journey. So that there is no stress also on growth metrics just for the unsecured product. Right now the entity is structured as an unsecured product, so the growth pressure also comes on only that product. So I think the diversified product nature will take away a lot of this pressure and cater to upcoming requirements of the households in a broader manner. Thank you.
I'll just take 30 seconds. I think risk-based, data-driven underwriting is what we've spoken about. We've spoken about diversification of the product segment or spectrum, and we have seen data showing that the customer of microfinance today after 5 years is a customer for affordable housing. I think Kiran already has covered that point. The last point I would like to make is access to long-term capital. With some of the large microfinance company going into IPO, and we see that mutual fund market is growing in India. So mutual fund houses have access to long-term capital, and with that long-term capital flowing into microfinance segment will give them much needed relief, and from a perspective of stress on the need for capital and cost of capital. I think these three things are the way forward for microfinance companies.
Thank you.
Yeah, I think 5 points from my side. First of all, talk about risk, because that's the major area to be covered. So I think one of the things was it's a regulatory issue as well. Now we are seeing that a lot of penetration on the urban and semi-urban and all. So now can we do a bit of push-based growth from a rural perspective, like what we call in branch bank segment is that we issue licenses in rural much more than urban. So there's some sort of push from, if it's possible from a regulatory standpoint, is you cannot open too many branches on urban and rural. It's a penetration issue. RBI knows what is the level of penetration of MFIs. So it should move towards the semi-urban and rural, right? That way, one, we are reducing the risk, and it's a very important way. We are not wronging in one place. Number two is, I think Nalini talked about fraud and issue earlier. So one of the major issues still is the cash collection, where we have disbursement through mostly digital. Still we are collecting cash, and I'll give an example of one entity.
Abhijit, I'm sorry to intervene. Let's avoid examples, stick to the points. We got really 6 minutes overshot.
Sorry?
We are short of time. Can you?
So you said 2 minutes, right?
Yeah. 2 minutes is fine.
Yeah, that's all.
Please.
I'll be done within 2 minutes. So second is that entity basically said on the ground that we only will take repayment through QR or Dash or whatever. So first day it so happened people came with the cash. They refused. I mean, somewhere we have to draw the line, right? They refused. So what happened? Second time they came with the option of QR payment, right? So we have to also as an organization force that. Third, coming from a credit guarantee perspective, we have credit guarantee corporations in India. Any entity, NBFC above 500 crores, generally can get a guarantee on the portfolio itself. That will reduce our write-off rates if you can structure it there. Fourth, which is a combination of capital and also risk is. These cooperative banks, I just picked up today morning 5 data of the cooperative banks. You would be surprised to know that all of them are profitable, good ROA. 65%, the credit to deposit ratio, which means by how much of deposit they have to their creditees, varies between 56% to 75%. That means they have more deposit than their credit. What does it mean? These are all local institutions. Is it fully governed, completely regulated by RBI? They will be RBI. NBFCs are regulated. So can we draw a similarity and allow NBFCs, MFIs to have deposits? Last part on that deposit itself is that a lot of large NBFCs takes cash collateral, pay you certain rate. Why can't we do it for MFIs? If that is allowed in a regulation, we should do that, right? That access of deposit is there. Last but not the least, 2 IPOs. One has happened in the SME boards, which is called IBL Tech. They have done a fantastic IPO almost 8 months back or 10 months back. It is doing well. Second, Usha is just getting listed probably. So we'll have to see. So let's wish good luck so that if this becomes successful, we have a avenue to get more capital and also show exit to our investors so that they see that this is a good asset class. Thank you.
Thank you. Gaurav?
20 seconds, I promise.
Yeah.
Okay, very clearly, joint families are becoming nuclear families. Nuclear families are trickling down to individuals. Eventually, the way Rahul said, it's the beginning of the end. From a JG, you'll have to start moving into the consumer side of specific customer underwriting will definitely come into the picture now. So that's a feature that is happening. From a digital perspective, everybody will copy whatever has been already done. Large fintech players will be vying for this kind of a customer as well. Where MFI can beat is knowing your customer better. The way the connect you have with your customer, nobody can beat that. Leverage on that and try to get a business out of it, because nothing else will, digital will be democratized, as I mentioned. Third, data and analytics piece. Again, Lot of banks, lot of NBFCs are too sophisticated in this space. My request to the MFI industry would be get more into the segmentation part, get more into the monitoring part, understand that customer from your people, knowing them, in person, and from sitting in the head offices, getting to the segmentation of the data, monitoring them better, understanding the customer better, and then taking actions. That's it. Thank you.
Thank you. I think I should really apologize on behalf of organizers here. This was originally supposed to be an on-hour plan. We had to cut down. Last 15 minutes were taken away. Even then, I think we are good. We are 55 minutes. We are still on time. So thank you, my esteemed panel members. Great insights. We should have had more time. If we had more time, we would have actually made the more insights into this. But thank you all for your patient listening. I'll now hand it over to my MC who is patiently waiting.
Thank you, panelists, for a very interesting and insightful discussion. As a token of appreciation and gratitude, we would like to present a small memento to our panelists. For this, I would request Mr. Natarajan, Chairman and MD of South India Finvest, to kindly hand over the mementos on behalf of Sagan. Please, sir. I would also request Mr. Rajagopal from Tata AIT to join us in the Mr. Jai Krishna, partner PwC. Mr. Rahul Gupta, Director and CEO of Avanti Finance. Thank you, sir. Mr. Kiran Kumar, Director and CEO of Swaman Financial Services. Thank you, sir, for joining us. Ms. Nalini Venkat, Chief Business Officer, Digit Insurance. Thank you, ma'am, for joining us. Mr. Ankit Ray, co-founder and MD, Investors Capital. Thank you, sir. Mr. Gaurav Agarwal, Assistant Finance Principal. Mr. Adi Gopal, Tata AIT. तुम आगे होना इसको लेके please join us for a group photo. Thank you. Thank you. All right. Thank you. Thank you, everyone.